This is Macro Horizons, episode 364, Fumbling Toward Winter's Finish Line, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of March 9th. On Sunday, one full hour will vanish, disrupting sleep patterns and ensuring someone will be running behind schedule. Not us, we have a smartphone. While daylight savings time holds the promise of longer days, so does the spring equinox, begging the question, why rush a good thing? Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the price action in the Treasury market told a very interesting story, and it told a story of investors being much more concerned with the developments on the geopolitical stage than anything necessarily coming from the economic data. As a result of the military operations by the U.S. and Israel in Iran and the subsequent Iranian retaliation, we have seen a sharp increase in energy prices, and with that, a backup in Treasury yields. It's worth noting that the backup in U.S. 10-year yields brought rates back into a very familiar range between 4 and 4.15. The fact that the prior week saw 10-year yields rally below 3.95 did create a very specific setup into the weekend's events and presumably contributed to the largely in-range response. It was the curve flattening nature of the move that caught us by surprise. All else being equal, we would have assumed that a refocus on higher energy prices would have widened break-evens, particularly in the 10 and 30-year sector. But what we saw was that the sharpest price action was focused in the very front of the curve. Now, to some extent, this is consistent with investors looking at a fresh round of reflationary risks and translating that into yet another reason for monetary policymakers to delay rate cuts further into the year. And that's precisely what we can see priced into the futures market. Monetary policymakers have been very non-committal in regards to what the potential fallout from the Iranian conflict could mean for the U.S. economy and therefore the direction of monetary policy. That's a very on-brand and as-expected response from the Fed. After all, if we learned anything from the trade war, it's that a spike in producer prices, whether that's through concerns about a supply shock, as was the case in the week just past, or higher tariffs, as we saw last year, that won't necessarily translate into higher realized core inflation, which was the risk for 2025 that didn't come to fruition, and potentially a near-term risk for 2026 that might also not come to fruition. We find ourselves pondering a different question, specifically, given that the trade war triggered so much uncertainty that then eventually translated into a no hire, no fire employment market, will the military action in the Middle East similarly lead to a spike in uncertainty that leaves business leaders reluctant to push forward with any major initiatives? It is a wild card to be sure, and as the military action in Iran is expected to take weeks and not days, it is an uncertainty that will likely linger throughout the rest of the quarter and into Q2.
In a typical environment, payrolls week would have been dominated by payrolls. But instead, before NFP hit the tapes on Friday, this week's move in the Treasury market, and frankly in financial markets more broadly, was obviously driven by the outbreak of war in Iran, with the US and Israel launching attacks against Tehran in pursuit of regime change over the weekend. Now, as we've learned in terms of the market's reaction to conflicts recently, it's no longer as cut and dry as war means flight to quality, and instead what we saw was, in a not dissimilar reaction to when Russia invaded Ukraine, the reaction in yields was more about the implications for the energy market and what a more material disruption in the critical region for oil production means for the cost of crude and broader inflation. And so Sunday night, after reaching 392 and well below the 4% level we had been targeting, the bulk of the week in the Treasury market was spent retracing that bullish move as investors contemplated what a more sustained higher oil price environment might mean for the flow through to inflation. And while headlines from the Persian Gulf were undoubtedly the main story this week, we also got a very strong ISM manufacturing print, a decent look at ADP, and another very solid read at ISM services. And so taken together, the potential for a more dragged out conflict in Iran, along with domestic fundamentals that continue to look solid, was enough to bring tens back to 410, more or less, ahead of Friday's main economic event, which was obviously NFP.
There's also an argument to be made that focus will remain as much on the conflict in Iran as whether or not the key shipping lane of the Strait of Hormuz is eventually fully reopened. The administration has pledged to potentially protect the shipping lane militarily if needed, as well as serve as an insurance backstop for shippers. Now, it isn't difficult to envision a weeks-long conflict in Iran that quickly fades from tradability if the strait is secured and energy prices come off of the local highs. It's important context to keep in mind that the front-month WTI crude oil contract peaked at roughly $80 per barrel. Now, this means that the conversation around the forward inflationary implications from higher energy prices is much different than if oil had been trading above $100 a barrel. It's also worth highlighting that a spike in energy prices, gasoline in particular, will translate into higher headline CPI, but not necessarily higher core inflation. Yes, eventually, $100 barrel in oil will translate into upward pressure on core goods via higher production costs. However, such an outcome would be contingent on how long energy prices remained elevated, which, in returning to our initial observation, means that the safety and effectiveness of the shipping lane through the Persian Gulf will be essential in attempting to gauge the ultimate fallout for the real economy. Taking a step back, one of the more surprising aspects of the recent price action has been the fact that the yield curve flattened rather dramatically as a result of the war in the Middle East. Specifically, 2-year yields pushed up near 360 in an impressive move that was accompanied by the market, for all intents and purposes, completely pricing out rate cuts in March and April. While there remains a non-zero probability of a June rate cut, the surprising aspect from our perspective was the fact that the market, at least ostensibly, is back in the mode of viewing all inflation as the type of inflation that the Fed would deem worthy of a monetary policy response. The monetary policy response in the current environment being simply to delay rate cuts further into the year. The unwillingness of investors to differentiate between the impact on headline inflation versus any eventual longer-term flow through to the core inflation series is notable and we'll argue is something of a recency bias based on the global macro experience of Russia's invasion of Ukraine, which was traded almost exclusively as a reflationary impulse as opposed to triggering any safe haven bid to treasuries or broader flight to quality. Now, the fact that the U.S. equity market has managed to stay in positive territory for year-to-date returns reinforces the notion that in the absence of a hit to the wealth effect, the Fed will have the flexibility of seeing how the inflation complex ultimately evolves before being compelled to resume its journey towards normal policy rates.
And in the vein of this conversation, it's important to remember the monetary policy context that was brought into this week's escalations in the Middle East. Specifically, that even before accounting for the change of leadership at the Fed and Warsh taking over in just a few months, the Fed has implicitly, if not outright said, that the inflation side of the dual mandate is under good enough control that while we're not at 2%, it doesn't really matter because the forward risks to the labor market are pronounced enough that an easing bias is still intact. And exactly to your point, Ian, it doesn't mean that this won't necessarily change if we enter an environment where oil is at $100 a barrel for multiple months. But all else equal, and operating under the assumption that there is not a broader spillover of the conflict, that the disruptions to the Strait of Hormuz are relatively limited, what this means is that gas prices might be higher, but even if we saw an uptick in true demand-driven inflation on the core side of things, that would also not necessarily imply that there was a material risk to Warsh's aims to bring the policy rate back toward 3%. Clearly, the Fed, including Powell, has demonstrated a willingness to tolerate an even longer runway back toward 2% core PCE, at least to look at the latest SEP, than would have traditionally been the case. Obviously, before payrolls, this week's data showed an economy that was hardly in need of a stimulative boost from less restrictive monetary policy, but that fact is probably not going to stop Warsh from continuing to cut once he takes over in May. And so, to your point on the flattening of the curve we've seen, Ian, to look at the shape of the very front end of the curve and the fact that we now have in the low 40s of basis points priced in cuts over the balance of this year, to us, the risks around front-end valuations from these levels are becoming increasingly asymmetric. Sure, we might not get 4 rate cuts this year, but it's also unlikely we're going to get less than 2. And given the distribution of risks around the path forward for the labor market, on a probabilistic basis, it's probably more likely we see more rate cuts under the new Fed regime than less.
It's also not lost on us that there are clear parallels between 2024, 2025, and now 2026. Specifically, we came into the new year with a unique set of uncertainties and unknowns. Recall that in the beginning of 2024, we saw higher than expected realized inflation, which created a fresh uncertainty for the Fed, resulting in an extended pause. Now that pause was resolved later in the year when the Fed began normalizing rates. Fast forward to 2025, the results of the election, combined with Trump's trade war, created fresh uncertainties that led the Fed to pause in its normalization process and delay rate cuts until later in the year. 2026 appears to be shaping up much the same. The war in the Middle East has created upward pressure in the energy complex, which has created an unknown regarding whether or not that ultimately flows through to core inflation in the U.S., thereby providing the Fed yet another reason to delay rate cuts at the beginning of the year, only to, as you point out, Ben, presumably resume those rate cuts in the second half of 2026. Again, to the point, 40 basis points of rate cuts priced in for 2026 seems low given the overall balance of risks. But that doesn't mean that in the very near term, this will resolve into a rally for the 2-year sector, thereby steepening the curve. As long as there continues to be a demonstrated amount of demand further out the curve, which we do expect will persist, the curve flattening trend will be particularly difficult to fade outside of potentially playing for a small, in-range, tactical re-steepening that affords the market a position to reload flatteners.
And away from strictly the price action in treasuries, it's also worth mentioning what we've seen in riskier assets. Ian, you mentioned it at the beginning of the conversation, but stocks have generally taken the outbreak of war in stride, and after initial early weakness to start the week, both credit and mortgage spreads have found their footing and seen reasonable demand. Obviously, in outright terms, with 10s now back above 4%, the pickup in IG and MBS represents a buying opportunity for those looking to add a bit more yield to their portfolio. And on mortgages specifically, the fact that MBS basis is now back to levels where it was before Trump's tweet about GSE buying of mortgages, there's certainly enough appeal on outright and in spread terms that as we settle into a macro backdrop that's going to be defined by what appears to be not a super fast resolution to the conflict in Iran, there are still buyers in credit, mortgages, and treasuries waiting to take advantage of higher yields.
And with the reopening auctions coming up, we're reminded, if you missed them in the secondary market, don't worry, Besant will make more. In the week ahead, investors in U.S. rates will continue to focus on developments in the Middle East, most notably the response of Iran to the ongoing military operations of the U.S. and Israel. The market has been content to trade it from the perspective of the forward inflationary implications related to the energy sector, and we expect that that will remain the case. However, the longer the conflict goes on, the less and less emphasis we suspect investors will give to each incremental headline. The administration has outlined a weeks-long timeline as opposed to measuring the operation in days, which suggests that continued headlines related to the Middle East will persist, but carry with it less obvious tradability. The week ahead also contains two key Treasury auctions, the $39 billion 10-year on Wednesday afternoon, as well as the $22 billion 30-year on Thursday. From a fundamental perspective, it is an important week on the data front. We have Wednesday's release of CPI for the month of February. Expectations are for a 0.2% increase in headline inflation and for a comparable 0.2% increase in core CPI. This will create an interesting dynamic because then on Friday, we get the core PCE figures for January. These figures are expected to show a strong measure of core inflation at 0.4, while we will argue that a core PCE at 0.4 is accurately priced into the market at the moment, particularly given the relatively low odds of even a June rate cut at this point, according to the futures market. The uncertainty is whether or not February's CPI release on Wednesday will weigh more heavily on investors' expectations for the forward path of inflation. We anticipate that at the end of the day, a core CPI print for February at 0.2 or lower will serve to offset the strength of core in January. Recall that there is a fair amount of seasonality to the inflation complex, and we do tend to see upside surprises in January moderate over the course of the quarter, certainly over the course of the calendar year. Friday also contains the personal spending figures. Now, personal spending in January will very much be in focus in light of the recent consumption trend. We'll be focused closely on personal spending in real terms, which is expected to be flat or slightly negative. Translating this all into what it means for the real economy, what we've seen thus far is that 2026, while continuing to see reasonable economic growth, is not poised for a repeat of the strength that we saw in 2025. Now, this doesn't mean that the Fed will rush into the process of normalizing policy rates lower, although it does give the Fed a reasonable amount of flexibility to respond to the evolution of the inflation complex, particularly in the event that we start to see this supercore series moderate back to the trend that was in place at the end of 2025. Overall, we do remain constructive on the Treasury market and see the path over the medium term being toward lower nominal rates, even as the Fed might struggle with reinitiating the process of normalization. At the end of the day, an on-hold Fed combined with a grab for duration will prevent the yield curve from materially re-steepening until there's compelling evidence and messaging that the Fed is poised to cut rates once again. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And despite ongoing attempts by Congress to end daylight savings time, it's still going, 117 years strong. Perhaps Congress should be burning the midnight oil, or the 1 to 2 a.m. oil, as it were. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.